AlgoIndex market close, Thursday, July 16th. 7,500. Write that down, because it did all the work today, and it was never printed on anybody's chart until the market was already leaning on it. 3 separate sources had it before the opening bell. Computed pivot analysis put first support at 75.01 and 61. The morning options read, listed 7,500 as support, and said the environment that buys your dips only survives while this index holds 7,500 to 7,600. And sitting on the strike itself, 43,000 dealer long calls and 33,000 dealer short puts. The S&P then spent 6 hours walking straight down to it. 10 minutes to 4, it printed 75.04 and 02 and quit going down. The last 10 minutes took 30 of those points back. One promise, and then I will earn it. The support that saved this market today has an expiry date, and the date is tomorrow. Stay with me, and you will know exactly what gets removed, and why that makes Friday the most mechanically interesting session of the month. Numbers, quickly. The S&P closed at 75.33 and 77, down 38 and 63 points, down 0.51%. The Nasdaq 100 took the real damage, down 1.6% to 29,025. Semiconductors were the source, off 4%. VIX rose to 16.72, up almost 7%. Its own volatility gauge closed at 97.31, up 6, both higher. Somebody paid for protection today. Session range, 88 basis points. High of 75.70 and 74 at 25 past 10. Low of 75.04 and 02 at 10 minutes to 4. Put to call volume ran 1.32. Then, the number that decides whether options are cheap. Implied volatility rank, 16.97%. Bottom 6th of its year. Hold this pair. Implied volatility closed at 13.32. Realized volatility across the same trailing month, 14.98. Protection got more expensive today, and it is still cheaper than the movement it ensures. 3 forces. Only one of them was strong enough to set the low. Leadership, and it was a rout in exactly one place. Semiconductors fell 4%. The memory complex is now down 30% in about 2 weeks. And the semiconductor group, 15. Korea's index, which led that whole trade higher, fell 6%. But software went the other way. Salesforce closed up 3% at 173. The money did not leave. That is what 1-month implied correlation at 4.7 is telling you. Index components pulling in opposite directions at the same time, which is the only reason an index whose biggest sector fell 4% got away with losing half of one. Flows second, and the record of the day is buried in it. Index hedging flow on the S&P finished flat. Single stocks finished at minus $2 billion, driven by longer-dated put buying. But the Nasdaq's hedging flow closed at minus $5 billion, and by the options Red's own 30-day ranking, that is the most negative reading it has produced in a month. Composition tells you what kind of minus $5 billion. Longer-dated puts bought, 0-day calls sold. That is not a liquidation. That is insurance being written on the technology sector, at size, 1 day before expiry. Mechanics third. Dealers are sitting in positive gamma, which means their hedging works against the move. Price falls, they buy. No opinion required. That is the environment, the morning read said, holds only while this index holds 7,500 to 7,600, which brings us to the 6 hours that tested precisely that. Start at the bell, because the whole session is one straight line to one place. 9:35. The S&P opens at 75.58 and 80, and immediately hands back 14 points. 10:35. High of the day, 75.70 and 74. Look at what it hit. Computed pivot analysis puts 2 standard deviation resistance at 75.70 and 06. The high went 0.68 of 1 point through it and turned around. The morning read had also called this market capped at 7,600 to 7,620 into expiry. Price never came within 30 points of finding out. Then 6 hours of lower. 12:30, 75.44. 2:30, 75.34. 3 o'clock, 75.27. 3:30, 75.16. 10 minutes to 4, 75.04 and 02. Now, The part worth the whole video. Everything sitting underneath that print was published before the market opened. Computed pivot analysis, first support, 75.01 and 61. The same analysis, 2 standard deviations down, 74.97 and 48. The options market's own implied low for the session, derived from what people paid, 74.98 and 51. And the strike, 7,500, carrying those 43,000 dealer long calls and 33,000 dealer short puts. 3 independent sources, 4 lines, all of them inside a band 4 points wide. The low printed 2.5 points above the highest one and reversed. Then the auction, 5 to 4, price jumps 17 points. 4 o'clock, 10 more. It settles at 75.33 and 77. And here's the figure nobody quotes. That final 4 o'clock bar traded 211,000 contracts, 8 times the median bar of the session. It was the heaviest bar of the day, heavier than the opening bell. The move that erased half the decline happened on the single largest concentration of volume this market produced, inside 10 minutes, on the eve of expiry. I will be honest about what I cannot separate. Part of that close is the 7,500 position doing its job. Part of it is an expiry eve auction rebalancing into the settle. Both are true at the same time, and today's data does not tell me to split. If you hear anyone give you a clean percentage on that tonight, they are guessing. Somebody bought this exact day, 1 session early. Wednesday's positioning, published in this morning's flow report, shows 2 put lines opened on SMH, the semiconductor fund, both expiring tomorrow. 10,275 contracts at the 600 strike, 6,482 at 570. Call it 16,700 contracts of 2-day insurance on semis, bought the day before semiconductors fell 4%. Both lines are clean buy to open, nothing sold against them. The 600 puts went from $22 to $35, up 59%. The 570 puts went from $4 to $10, up 150% in 3 hours. The mechanism deserves a sentence, because it is the same one holding this index together. As that 570 line crossed from out of the money to in the money, its gamma rose sharply. That made its delta accelerate, and that made the position gain faster the further price fell. Gamma is not only the thing that pins an index, it is also what turns a $4 put into a $10 put before lunch. Protection repriced today, and only one way. Fixed strike volatility rose 0.5 point to 2 full points across the entire curve. That is not one nervous expiry. That is hedging layered onto every maturity at once, the day before expiration. But look where it repriced from, because it is still wrong. Implied 13.32 against realized 14.98. Last night, that gap measured 2.15 volatility points. Tonight, 1.66. It narrowed. It did not close. The morning read said it plainly. Despite the weakness, nobody wants to buy index puts, and they will not argue with that until this index breaks 74.80. In semiconductors, it is already different, where the skew has flipped from call heavy to put heavy. The hedging is happening. It is just not happening in the index. One caution I owe you on that report. Its automated summary opens by calling the largest premium trade of the day a bullish bet on S&P calls, $387 million at the 6,300 strike. We opened the print. It is 2,950 contracts sold, not bought, 1,200 points in the money, tagged as one leg of a short strangle. We will report what it is. We will not tell you what it means. 8 setups, 4 filled, 4 armed, and never triggered. Of the 4 that filled, 2 winners, 2 flat, nothing lost. Now the part I would rather skip. All 4 were closed by hand, and the last exit cleared at 11:51 in the morning. This desk was flat before lunch. Everything I just spent 4 minutes on, the 6-hour walk into 75.04, and the 30-point auction that took it back, happened after we had stopped. So, a clean sheet, 0 losses, and 0 participation in the only move that mattered. Both of those are true, and I am not going to use the first one to cover the second. The one that stings is on the record too. Just before 11, we bought a put against the day's ceiling. It was right. We closed it 7 minutes later for a winner. The thesis then kept working for another 6 hours without us. No dollar figures on any of these tonight. The fills are a type our own rulebook refuses to let us score in money. The outcomes come off the chart. Expiration Friday, and the map is crowded. Scorecard first, because you get one every night, whether it flatters us or not. Last night on this show, we called for neutral with an upward tilt into Friday. The index fell 0.5%. That was wrong, and I am not going to soften it. The same broadcast ended by naming one number, 7,500, and telling you to judge this market by its behavior there. Today's low was 75.04 and 02, and it held into a 30-point close. Wrong on direction, right on the level. If you take one thing from that pairing, take this. Our direction calls are opinions, our levels are arithmetic, and you should weight them accordingly. Tomorrow, the expiry pin is genuinely contested, and you're getting both readings. Calculated on the index itself, maximum pain sits at 75.20, which is also, exactly, the primary put support. Calculated on the big fund and scaled up, it sits at 7,500, the strike that defended today. We closed at 75.33 and 77. Both pins are underneath us. They are 20 points apart, and we are not going to pretend they agree. The magnet strikes are stacked below too. 75.27 at 96.8%. 75.19 at 97.3. 75.12 at 98.8. Everything carrying real probability tomorrow is lower than where we closed. The map. Gamma ceiling 7,600, which is also the largest gamma concentration strike. Volatility inflection 75.45. Put support 75.20. Dealer gamma flip level down at 74.72. Overnight, Netflix reported, in line on earnings, but revenue and free cash flow both missed, and the guidance was worse. The stock is down 9% after hours, which is more than the 8% its options were pricing. Around 68, roughly 40% lower on the year, and there is a 100,000 contract put selling position at the 65 strike. The 52-week high is 76.20 and 90. We sit 1.14% beneath it, and momentum is nowhere near stretched. The 14-day relative strength index does not reach 70% until 78.19, almost 286 points above here. What changes it? Above 7,600, the ceiling zone the morning read named opens up. Below 74.80, that same read says the positive gamma slope deteriorates and flows force a sharp move lower. And the honest one. The 7,500 position that caught this market today expires tomorrow. Expiry removes it. If this index needs that strike on Monday, it will not be there. That is Thursday. Almost everything in the last 5 minutes came from data most people never see. What you can have for nothing is the journal. Log a trade, and it grades the entry against the levels that were actually live when you took it. members.algoindex.com/auth/signup. We keep our level record in public because a level you only hear about when it works is advertising. Every forecast scored at algoindex.com/tools/gamma-level-accuracy. Tonight's full numbers go up in writing at algoindex.com/blog. Last night, I told you to watch 7,500, and it held. I also told you this market would tilt up, and it did not. Tomorrow we score both again, in public, whichever way they land.